even Hernig said, the only thing keeping us from oblivion is a banking crisis. The only thing keeping a banking crisis alive is time. And so when we have a market crisis, and it will probably be led by a banking crisis or a mean reversion, you're going to see QE to the moon. That's going to look like a solution, but that's going to mean be careful what you ask for, because that's simply at the expense of your currency. And that's why gold isn't, to me, an argument or a debate. It's common sense.
So over the last 50 years, there's been many unforeseen events, some call them black swans, that have helped to shake and shape markets, the economy, and ultimately gold and silver. Events such as August 15th, 1971, the pause of the gold-backed dollar by President Nixon.
Temporary pause.
The pause, you know, or the 1987 market swoon, or the 2000 dot-com bubble burst, or the 2008 great financial crisis, or the 2020 pandemic. Are conditions becoming favorable again for another unforeseen event to severely rattle markets, the economy, the faith of consumers everywhere in the current financial structure?
Well, yeah. I mean, what's the last good narrative we have right now in the U.S.? I mean, think about it. It's our S&P, it's our NVIDIA, it's our tech, it's AI, it's the new meme. It was the .com meme before that. It was the real estate meme before that. I'm not saying AI isn't important, or microchips aren't important, or that AI and chat GDP isn't going to change things. But the idea that technology is going to make up and fill the gap for all the sins of spending beyond our means, that permanent ruin that Hemingway warned about, the idea that that's going to be enough to fill the gap, I think is naive. I think it's political. I think it buys time. It buys hope. Markets are psychological. In many ways, that seismic shift that you're worrying about, that turning point, is already happening. It's happening in the fracturing of our society. It's happening in the layoffs and the bankruptcies and the corporate bankruptcies and the poverty rates. It's happening in our social unrest. It's happening in our political distrust. It's happening in our distrust of the fourth estate. It's all around us. What's keeping us afloat right now is hope that the S&P will save you, or that we're still the greatest stock market on earth. We're not the greatest manufacturer like we were after World War II. We're the greatest outsourcer. We're not the greatest creditor. We're the greatest debtor. So you have to look at this objectively. In a lot of ways, we're already there. But I think even Hernig said, the only thing keeping us from oblivion is a banking crisis. The only thing keeping a banking crisis alive is time. And so when we have a market crisis, and it will probably be led by a banking crisis or a mean reversion, you're going to see QE to the moon. That's going to look like a solution, but that's going to mean be careful what you ask for, because that's simply at the expense of your currency. And that's why gold isn't, to me, an argument or a debate. It's common sense. It's a common sense allocation. Doesn't mean you have to do all gold or 50% gold, but you can't ignore it. And the efforts the banks have made and the Wall Street crowd have made, because they've invested in not seeing gold rise, because they can't profit off trading it, they can't churn it, and they certainly don't want to see the dollar get too embarrassed. So it's not part of the mainstream narrative. It's not part of the headlines. But in the contrarian informed community, and the very intelligent high net worth community, and the family office community, and even obviously in the central bank community in the East, it's a no-brainer. And what's interesting, Gary, is, you know, the 40-year mean for gold allocations is like zero. It's 2% allocation out of a whole portfolio. That's nothing. But right now, the current allocation is 0.5%. So just a reversion to the mean in gold to a 2% sends the gold price up significantly higher. Or if we go to 5 or 6%, even higher. So even in terms of price moves, gold goes higher just by mean reversion. But the fundamentals are all there for gold to go higher. But again, when gold's at 5,000 or 10,000, a cost of a loaf of bread or a tire for your car or your child's tuition is going to be much higher too. So it doesn't mean that the gold makes you rich, but it keeps you from getting poor. That's the only thing you can do in the long run. And to me, that's good enough, but that's not often good to hear from people that are going further and further on the risk branch, just trying to make some money right now, trying to get by because they feel so trapped. I understand that, but I think they're misallocating their thinking to what's more important, preserving your wealth or losing your wealth or risking your wealth. And to me, again, yeah, I'm a gold bug, but to me, it's common sense.
So, Matt, there's been a few terms here, recency bias and mean reversion, that have been expressed. How do you see recency bias and mean reversion playing out over the next few years as it pertains to growth and value? And also, who gets hurt the most here as these things play out?
Well, look, like we just discussed, mean reversion in gold is going north just by simple allocation increase, just because I think we're well below its 40-year means. And the fundamentals and even the technicals for gold to hit its mean are obvious. Mean reversion in the market means a much lower S&P, Dow, and NASDAQ, which kills the pension funds. It certainly kills those that are taking, their retirement in the account, and they think that their IRA is going to be the same as it was 10 years from now as it was 10 years ago. So that hurts the middle class and the working poor the most. The top 10%, which owns most of the S&P wealth, will get stapled a little bit. They'll get gut punched, but they won't be ruined. The real losers here is the average citizen, the average American, because of the purchasing power of their currency. So the mean reversion of the markets, the mean reversion of the dollar down because it's so overproduced, over synthetically created and debased, that is clearly for the man on the street. And even for the wealthy, those that don't have gold are going to get, I think, spanked even more. And you could argue that this time is different. The S&P will never fail. Despite 2 sigma moves off of its mean, you could argue that. But I think what this means is a lot more of that permanent ruin that you opened up with Hemingway in the beginning to come. And that sounds no fun at a party. That sounds gloom and doom. That sounds negative. I get it. It's depressing. There are things you can do. Gold, I think, is one of them. You could find other real assets that hold their value more than currencies, or overinflated S&P or an overinflated NASDAQ or Dow, or certainly a completely respirator credit market. I mean, Gunleck said you'd have to be an idiot to buy treasuries when you look at real inflation, because you're literally losing money. That's Gunleck. That's not a gold bug. So again, I apologize. I'm sweating profusely here. I'm so hot. But again, it's wherever I look, without trying to just be biased, I just look objectively at credit market risk. It's obvious. It's here to stay. It's here right now. It's not projected. It's not beating inflation. We know that the CPI inflation scale is misreported. We know that. Everyone knows that. We know that equities are in a massive bubble in a highly narrow, concentrated market that is unsustainable as soon as profit margins go south in these otherwise good companies that are overvalued. The PU ratios are extraordinary. Again, Grantham, Dalio, others who are experts in equities would say the same thing. So mean reversion in equities is dangerous. Mean reversion in stocks and bonds are both dangerous. And mean reversion in precious metals is going up. If you're playing where I say the polo ball or the hockey puck is headed, you follow it where it's headed, not where it's sitting now. And it doesn't mean gold goes in a straight line, but it will certainly do better than those other highly volatile, highly overvalued and inflated asset classes. And it will certainly hold its purchasing power as a store of value better than those as well. Again, I don't know why this isn't obvious, but it's not making the headlines. And many will just think I'm apologizing gold bug out of Switzerland, but I understand.
So before I go to the next question, I wanted to comment on how hot it is there, and that it's 95 degrees there. It's no 95
degrees in France.
And
sorry.
We just appreciate. Well, I had an interview a couple of months ago in a similar situation, but we just so appreciate you being so determined and such a trooper that you're just hanging in there regardless of how hot it is.
Yeah, it's crazy here.
So thank you from all of us watching. We really appreciate your determination and perseverance here.
Sorry, I'm in a sauna here.
So you're going to be jumping in a pool as soon as we get
right after this call.
Okay, so Matt, in your analysis, with all the global debt, the unfunded liabilities, the ticking time bomb derivatives, does the world need a gold-backed currency? And is that what's needed ultimately for the world to move to gold? You've expressed, I don't understand why the message isn't getting through. I don't understand why they're not paying attention. I don't understand why they're not understanding the math. I'm with you in that camp. But what's needed for the world to move to gold? And does the world need a gold-backed currency again in some shape or form?
Yeah, you could argue. I think it's highly unlikely that it will go to a gold-backed dollar again, although you could argue the Heritage Foundation is talking about getting rid of the Fed too, and getting rid of the Federal Reserve and getting back to a chaperone currency with a gold backing or gold coverage. That's a speculation I'm not willing to make. I think it'd be very hard to do. For one thing, I think governments, including the BRICS, don't want to have a gold-backed BRICS currency, or the U.S. doesn't want a gold-backed dollar, because that limits the ability of these sovereign nations to actually create more money at will when their backs against the debt wall. So they want the flexibility to base their currency, being realistic. But what happens is, I think, especially in the BRICS, is what I've been arguing for the last few years, is you don't need a gold-backed BRIC currency. You just need to net settle your trades in gold. That way, for example, Russia and China is a classic example. Russia has a lot of oil, and China needs it, right? So, but China doesn't want to buy oil in U.S. dollars, so they'll buy it from Russia, and they'll pay for that in yuan. So Russia will take the yuan, and they'll use that yuan, and they'll use it to buy a lot of things in China that were, by the way, once made in America. And whatever the difference is in the currency, they'll net settle that in gold. And by the way, India can do the same thing. Brazil can do the same thing. They're using gold to net settle trades. It is a chaperone unofficial. It's an unofficial gold-backed trading settlement currency. It doesn't have to be a BRICS, Glassiev, Bulbakov, idea of a BRICS gold-backed currency. To Rick Rule's point, I said this in a conference a couple years ago. We both agree. I don't think any country wants to give up its right to debase its currency. But while they're settling trades at the current valuation in real assets, they'll net settle that in gold. And that explains why the central banks in the East are stacking gold at record levels, because that's where they get their credibility. Now, yes, you could argue that the US dollar or a major currency to get back to normal has to have some type of gold coverage. I think that's hard to foresee in the next 5 to 10 years. It would take a major mistake, a major crisis, but I think the next crisis will be solved not by going back to sound money, which is what you should do. Next crisis will be solved by blaming it on somebody else, on little green men from Mars, global warming, which I'm feeling today, COVID, whatever. You'll blame it on something else, and then you'll print more money, create more debased currencies, solve another debt crisis with more debt, and monetize that at the expense of your currency. It's inflate or die. That is more realistic to me than going to sound money with gold-backed currencies, because that limits the sovereign's ability to increase their debt levels and screw the people. So realistically, I don't see a gold-backed currency. I could be wrong. I see gold being far more involved in net settling trades, especially among the BRICS. And that group of BRICS nations is getting bigger and bigger with more important players. Again, Saudi Arabia, the UAE, etc.
Let's talk about, the net settling and the bigger, more and more players and the need for this gold. It would require it's going to require an increase in production of gold, or they're just going to grab the availability that's on the market, and that would lead to a decrease in supply, wouldn't it, for the investors who want access to it?
Right. If there's a decrease in supply, it's going to push the price up even higher if you're just looking at price optionality. Right now, and again, we talked about this before this heat-driven call, that, I'm not a mining expert. Ross Beatty, Rick Rule can give you far better advice, but we all know that as in terms of being undervalued, the mining sector in general is incredibly undervalued right now. If you're playing the long game and you can pick your athletes carefully, it's a no-brainer, because the production cost of gold is still well below the spot price of gold right now. And so for the smart miners, the good ones, because that's what the risk is in mining, it's the operational risk, it's the management risk. Mark Twain's famous quote, "Show me a mine, I'll show you a liar standing in front of a hole in the ground." But that's not true of all mines. It's not true of all operations. It's if you can sift through the good ones, the M&A deals that are being made by good operations, or even the broader indexes, as gold gets more and more mathematically, fundamentally, and even technically higher, the mining stocks are eventually going to do what Rick Rule said, reward infrequently but extravagantly. And I think that's what's going to happen. It's just very hard to keep that patience when you're seeing NVIDIA ripping. But we also saw AMC and ARK ripping too, but we all saw what happened to that. So again, if you're playing the long game and you're thinking realistically and you're a little bit careful in your due diligence, there's an incredible opportunity in the mining space. I personally am past the speculation point in my life. I'm just preserving what I made and what I have. And again, that's a flippant, smug thing to say. Not everyone's in the same box. So I understand that. Everyone has to look at it for different reasons. But there is going to be some real winners in the mining space. Absolutely. Absolutely.
I think it's not flippant. I got to be honest with you. I think it's very important for folks to understand that there are people at different stages of life, and those who are at the stage that you're at, the number one issue is preservation, and that is okay.
Yeah.
But
even my son, I say, he's 27. He's not retired. He's not done. He hasn't had his high moment yet. He's hadn't had his low moment yet. We all go through cycles financially, personally, philosophically. It's life. He's not in a position where he's worried about wealth preservation, but even my son and my daughter can afford an ounce here and there. They're thinking, again, they can preserve a little. They can still go to their parties and hang out and do what 20-somethings do. And even people that are, and I get it, I think the hardest part is for people that really are literally getting through the month, wondering. And I see it all around Europe. I see it in the US. I've traveled a lot this year. I was just talking to my daughter who's with her grandparents in the south of France. The other side of France is melting away here. I'm melting on the Atlantic side. But, there used to be thousands of people on the beaches there and near the Pyrenees, and there used to be restaurants open. And she was talking to some young people that were trying to sell paella, and they said there's no buyers because there's no people that can't afford these vacations and camping grounds, not just fancy hotels in Antibes or Monaco or Biarritz.
Evidently, they can't even afford McDonald's.
It's $20 for a couple Big Macs.
If you've seen their stock got hit recently.
Crazy. And you know, you take that little example though, it's $30 or $40 in tolls between Bordeaux and the Mediterranean, and that's in Europe. But I know in America, the GW Bridge and getting gas to go from New York to Hartford, Connecticut, people are literally making plans not to visit cousin or grandma or brother because the gas and the tolls make it too hard to get through the month. That is terrifyingly sad, and that is not sensational. And believe me, my clients are high net worth, but I come from the Midwest. I'm from Michigan. My mom was struggling as I was growing up. I am not immune to that reality. And I'm not saying, well, hey, you know, you're struggling month to month, go buy a kilo of gold. I know that's not an easy answer. I know that's a really hard thing to hear. Yet, and what can I say? Even an ounce, a gram is very hard at that price point for people. They're just trying to get to the money, and that's where it really is the great tragedy, Gary. Because not everyone even has the option to take care of themselves. They're just trying to keep their nose above the water level. I think that's the permanent ruin. Again, Hemingway warned of. And there's no one to blame but those political opportunists at the Fed, at the White House, at the Senate. Very few, maybe a few exceptions, but very few of them give a damn about the greater population. Right. They are supposed to be public servants. They are self-servants. I'm convinced of that. And that's a cynical thing to say. But to Hernig's point, if politicians actually care about the next generation, they wouldn't have made these policies. They wouldn't have done this to the currency. You know, and Hemingway warned that in the 40s, but Thomas Jefferson warned that in the 18th century, and Andrew Jackson did too. You're prostituting. You know, your politicians are prostituting their representation at the expense of the many for the benefit of the few, and that's what we've done to our currency. That's the permanent ruin, followed by that temporary prosperity of the 90s and the .com and all the great bubbles we've had and the great rise we've had since 2008 on printed money. It's helped the top 10% more than anyone else. And hence the social unrest, the social fracturing, the blaming whites versus blacks, rich versus poor, elite versus non-elite schools, right, gay versus straight. We're fighting about abstractions when the real problem is we just don't know how to get through the month. And that's a political problem based on a financial screw up.
Yeah. And the scary thing is the cohort you're talking about that's suffering, just trying to keep their head above water. That cohort is growing and is going to continue to grow the longer this goes on. So more and more affected people. But Matt, there's been talk for a while now, the last several years, of a commodities super cycle. It's been quite the hot topic really since their bottom in 2020. Commodities have certainly shot higher since then. However, their returns are nothing like Nvidia and other growth plays. It's just not even close. Do you see a commodity super cycle forming, and what data leads you to the conclusion? Or is it even outside of data? Is it more perceptual?
Well, I lean on Ronnie Sturfula, an Austrian economist who has a fund called Incrementum out of Liechtenstein. He's an advisor to von Greyerz. He writes the In Gold We Trust report. He's brilliant. And he came out with a chart last year. He called it the chart of the decade, which was just the commodity super cycle, the S&P versus real assets. And it looks like an EKG, up and down, up and down. And you basically see these long periods where the S&P is ripping and commodities as an index are getting clobbered. And then it reverses. And then the S&P is getting clobbered and commodities are ripping. And again, it goes back to my point earlier, is playing where that hockey puck is going to be, not where it sits. And again, it's hard. The opportunity cost of getting on NVIDIA or Bitcoin or some tech stock du jour right now is very hard when you're going into an unsexy commodity play. Yet if you're playing 10 years out, you want to do what everyone says they do, but no one does, which is buy low and sell high. Everyone right now is chasing tops. That said, for a commodity super cycle to be believable, though, if we have a recession in the interim, well, that affects commodity prices too. So it can be a long time before commodities as an asset class, as a whole asset class, start to really get their tailwind. And so there's a lot of caution. There's a lot of out of sight, out of mind. There's a lot of skepticism. But again, it depends on what kind of investor you are. If you're a speculator trying to get some easy lottery ticket, respect that. Take your risks. Have your eyes wide open. If you're a longer-term investor playing the long game, like Beatty and Rule and myself and Egon, we make 10-year decisions, not 10-month Twitter decisions. But that's not, again, trying to be flippant, but you got to think, what's your personality, what's your need, what's your profile? When you see something cheap, it's going to be necessary, you buy it. When I saw oil go down, I didn't need to be an oil expert. You just buy it. Even as negative as I was on the stock market, when we had that temporary crash in March of 2020 during COVID, and when the Fed announced unlimited QE, as disgusted as I was by that decision, I was pedal to the metal long equities because they're giving you a fat pitch. In terms of an equity or commodity super cycle, it's inevitable. Can I time it? Absolutely not. Can I see what'll signal it? Yeah, when net income margins on the big tech stocks go down instead of north. Just watch the net income margins. Watch when they consistently go from north to slowly south, like Lucent did, like Amazon did, like Commerce One did in the 90s or the dot-com bubble. If you know how to trade and you know what to look at, you can see when those cycles begin. I can't say it'll be November 27th, 2025. I don't know. I know what to look for. And if you do, great. If you don't, you got to do your homework. Get informed. Listen to me. Listen to people who disagree with me. Listen to you. Listen to people who disagree with you. Get informed. Again, I'm quoting Rick Rule because he says it better than me. The best investment you can make, as Pollyannish as this sound, is an investment in yourself. Learn. Be skeptical. Be skeptical of gold. Be skeptical of Bitcoin. Be skeptical of the dollar. Be pro-dollar. I think the more you look at history and math and market cycles, for more than just a couple hours on YouTube, the more you take notes, write this down, track it down, listen to people that are experts in their field, whether it's Jeremy Grantham or Jeffrey Gundlach or Bill Gross or Ray Dalio or me or Egon or Ronnie or whoever in their respective classes, you'll see a lot of consistent overlap. We're not trying to spread sensations. We're trying to spread common sense. It's very important to get informed. That's free. That's free.
Well, folks, that was worth the price of admission right there. That answer to that question, that was spectacular. Matt, is there a specific real asset class that has your close attention right now?
Well, look, it's obvious. And this is what scares me the most, Gary. I've said this more than once. It scares me how much conviction I have in gold right now. It's almost too much. That always worries me because the law student in me always looked at both sides of every case. That was how I created a brief. You got to look at the strengths and weaknesses of both sides. You got to try and make an argument for both sides. To me, the case for gold is so obvious. That doesn't mean gold goes from 20 or 2,000 or 2,400 to 5,000 tomorrow. It doesn't mean it doesn't have pullbacks. It doesn't mean you can't see sympathy as markets go down. There's a sell-off in gold to cover margins. I don't know. I just don't see any scenario where gold doesn't do significantly higher than it was now. And I remember doing an interview with Kitco a few years ago. It was at 1,600. She asked me, I said, it'll be significantly higher. Well, that was just a few years ago. Now we went from 16 to 2,400. Yeah. I'm not trying to be, it's a mug's game to speculate on price moves on dates.
Right.
But I cannot see a scenario where the way the de-dollarization is going, the way the petrodollar is going, the way debt levels are going, the way currencies are being debased, the way central banks are debasing their currency to stay afloat, that even if we have a global Plaza Accord reset or Bretton Woods 2.0, I don't see a place where gold doesn't have an increasing role, like it already does in the BRICS nations for net settling their trades, and where China and Russia are going. Whatever you think of China and Russia, I'd much rather live in Washington, D.C. than Shanghai or St. Petersburg. I'm not anti-American, but I'm saying look at what the world is doing, look at where it's going, look at where these rising economies are doing with gold, look at what central banks are doing with gold, look at what smart money is doing with gold. It to me, my number one asset class, yes, is this very asset that I'm selling my book on, that I'm pitching every day to our clients. But I absolutely believe it. And what scares me, Gary, is I'm thinking, what am I missing? Is it that Bitcoin replaces gold? Even if it did, I don't think gold goes down. But I don't see that either. I don't see Bitcoin dying tomorrow either. But again, it's not Bitcoin or gold. I just don't see a scenario when I look at what nations and central banks are doing and what countries are doing with gold. Not necessarily what the guy in the street is doing with gold, or not even what BlackRock is doing with gold, but what the world is doing with gold. I can't help but be bullish. And I don't want to mislead people, but I'm almost too bullish. It's the asset class that I believe in. Egon, my partner, started buying gold, and everyone laughed at him at $200 or $300. And he put most of his assets into gold. He eats what he says. He eats his own cooking. The kind of wealth he's made just on price appreciation is extraordinary. But more importantly, the conviction he had that no one understood 20 plus years ago, it's not that he's getting the last laugh. It was just he was contrarian with information, not emotion. Contrarian with the facts, contrarian not just with what the market was not saying, but what history taught us and teaches us all about what governments, to Hemingway's point, do to currency, how they create permanent ruin, and how they blame it on everyone else but themselves. And that's exactly what we're seeing right now. Exactly what we're seeing.
Well, that was powerful. And I'm just so appreciative. I know everybody else is, that you have conducted this discussion from the sauna and stuck it out.
My shirt gets darker and darker as you keep going. I'm watching myself.
It's really been an incredible conversation, Matt. Before we wrap up here and I ask Matt our final question, I want to point everyone over to our Substack. It's free. Go to metalsandminers.substack.com. We post free content on the consumer, economy, markets, AI, individual metals and miners, and we put up every single expert interview just like this one that we conduct. When you subscribe, we want to give you a free gift. It's a report that we wrote. It's based on the important Ray Dalio foundational premise. It's titled, "If You Don't Own Gold, You Know Neither History Nor Economics." This free gift is a must read for everyone on why we all should own gold. So head over to metalsandminers.substack.com, put in your email address to subscribe and receive the free gift on us. Also, I'm positive that you've enjoyed the conversation with Matt as much as I have. Please let him know. Hit the like and subscribe button and leave a comment below the video. It's time for the Golden Nugget segment, Matt. Let's just discuss portfolio positioning real briefly based on everything we've discussed today and with your experience and worldview as the backdrop. How are you positioning for the next 12 months? What assets do you like and what assets do you absolutely want to stay away from?
Well, like I said earlier, I was really, as cynical as I was very bullish in April of 2020 when the Fed announced QE, unlimited QE. So I went high into equities. I was very bullish again in January of this year in equities because the Fed was promising rate cuts. And look what the markets did without even a rate cut. And look what they did in 2022 when we said they were going to be higher for longer. Markets went upside down. So markets are very Pavlovian on what the Fed does or says. If the Fed is dovish, markets go up. If the Fed is hawkish, the markets go down. Just dovish talk has pushed even junk bonds higher than their fundamentals. So in terms of my portfolio this year, and I'm going to say it because it's going to change as we get closer to the end of the year, I was still playing the equities at about 20%. I was out of credits. I was out of government bonds because they're not beating inflation. I won't take junk because it's too risky. So I was mostly in cash, and then largely the majority of my money will always be in gold. It just is. You can watch certain signals. You can get certain tailwinds. You can pick up dimes, quarters, and dollar bills in front of this train. I, like Jeremy Grantham, am waiting for mean reversion, and that could be a long wait, especially as we still get these Sigma moves with this new technology meme that's blasting us way beyond bullish territory, way beyond bubble territory. But I'm old enough yet young enough to know what a market bubble is. I'm young enough to wait for blood in the streets for mean reversion, and then I'm going to go hog wild into equities. I'll never pick the bottom correctly. I won't get the very bottom, but we'll know it when we see it. So I'm mostly right now in cash. When I say cash, that means in gold, because gold is my store of assets, my store of value. When I want to use equities to fight inflation, I want to make sure there's a massive tailwind and a massive value play. There's almost no value right now in the equities market. So I'm just positioned right now in gold, a little bit in equities because I think there's going to be a rate cut. I think this bubble is going to pop at some point when net income margins on the big tech names go south instead of north. Right now they're going north. You can ride that rhythm if you want. For many people, I think if you're not trained, and I'm not even saying the best trained guys get it right, but if you're not trained in looking for those signals, whether they're Bollinger Band, Keltner bands, net income margins, balance sheets, financial statements, if you're not really a professional trader and you're just going passive with some RIA du jour on the street who can put you in a 60-40 portfolio, be very, very careful. Be very careful because equities and credits are highly correlated. There's no yin yang, zig and zag. They're going to go down together. And so if you're not a professional trader and you're just relying on the traditional portfolio, be very nervous, be very skeptical, go to cash. And if you go to cash, put a lot of that cash into gold. That's that's what I would do. There's going to be others who would disagree. They're going to say tech's the new solution. AI is going to get you there, and it could for the next 6 months. But to answer your question, I'm highly into real assets. The majority of those are into precious metals, 80% gold, 20% silver, a little bit into equities because I'm waiting for this little tailwind euphoria. And then I'm watching very carefully what the top 5 names in the NASDAQ and the S&P do when their profits go from north to south. Because when that happens, I'll probably end up going short the market at that point. That's where the real money's made because markets go down faster than they rise. But this market can stay alive a lot longer based on more synthetic liquidity, which kills the currency, hence gold, or on the meme, the new meme, which is AI, chat GDP, all that stuff. I think it's a sucker's market. It's plankton for the Wall Street whales. And I know people are making money on it, but unless they know how to get out or when they get out, it's very, very dangerous.
Matt, thank you so much for coming on to Metals and Miners and for being so generous with your time, your analysis, your ideas, and all of your sweat. It's been
blood, sweat, and tears.
It's been wonderful to spend the time with you. Would you please share with the viewers what's the overall theme you want to leave with those tuning in, where they can learn more about your work and how they can connect with you?
Yeah, well, we're at vongreyerz.gold or vg.gold. And we also have a URL called Gold Switzerland, which we've had for decades. We changed the name to Von Greyerz out of respect for our founder. Egon von Greyerz. So you can find all our articles and interviews, including this sweaty one there on vongreyerz.gold. We have a lot about, it's free. Again, it's all our interviews, articles on the macros, gold, credit markets, stock markets, bond yields, Fed policy. It's all there, years of it. So you can get a free education, very biased conviction education from us. There's also a really important section. It's not just why gold. Once you understand why, it's also how to own gold and how not to own gold. And there's a free education there. Clearly, we have a bias. I say this all the time, but it's a conviction. And you can read all our insights there and see our interviews there. And my other point, again, gold is not the solution to everything. It's not the solution to every political or social problem. It's not the solution to every market problem. It is a key solution to currency risk. Currency risk should be open and obvious now. So if you can, well, even the smallest amount, start getting your own little gold reservoir going. For higher net worth clients, obviously we have this incredible vault in the Swiss Alps, et cetera, but get informed, get educated. That's the most important thing. Get prepared, get informed rather than emotional, do something rather than complain. And I could say, elect a better president, but I understand that most people will be very, very polarized on what that even means. So right. I'm not even sure anyone can save us at this point. That sounds pretty dark too. Maybe that's why I'm sweating so much.
Well, I look forward to having you back on with us, Matt. And thank you for being here with us, and everybody else. Thank you for watching.
Thank you, Gary. It's a real pleasure.
I want to point everyone over to our Substack. It's free. Go to metalsandminers.substack.com. We post free content on the consumer, economy, markets, AI, individual metals and miners, and we put up every single expert interview just like this one that we conduct. When you subscribe, we want to give you a free gift. It's a report that we wrote. It's based on the important Ray Dalio foundational premise. It's titled, "If You Don't Own Gold, You Know Neither History Nor Economics." This free gift is a must read for everyone on why we all should own gold. So head over to metalsandminers.substack.com, put in your email address to subscribe and receive the free gift on us.